In Q1 2026, global energy markets took a massive hit. Global crude supply dropped 10%, and liquefied natural gas plummeted by 20%. Attacks in Qatar knocked vital extraction operations offline. When supply chains fracture and assets go dark, standard exploration companies lose their primary revenue streams and watch their margins evaporate. Yet, in the exact same 3-month window, ExxonMobil generated $8.7 billion in operating cash flow. Extreme volatility wreaks havoc on specialized market players. For an integrated giant, these market shocks provide the specific conditions required to flex refining capacity and capture higher margins elsewhere in the portfolio. ExxonMobil operates as a highly complex, self-balancing ecosystem, relying on 3 weights: upstream extraction, product solutions, and low-carbon solutions. When unpredictable supply shocks hit the market, one side takes damage, but other segments instantly pivot to offset losses and maintain dividend yields. This system produces engineered financial stability, treating global energy production as a volatile raw material that must be managed through scale. We can see this exact equation play out across the company's 3 main operating segments during the first quarter. This chart tracks industry margins. Middle East attacks impacted 2 LNG trains in Qatar, restricting upstream natural gas production. But that identical constraint tightened the market and drove up refining margins. Notice the blue and red data points, elevated well above the historical gray baseline. To capture those exact margins, the product solution segment ramped up operations. The company leveraged its massive U.S. Gulf Coast footprint to push throughput up by 200,000 barrels a day in March alone. Geographical losses in overseas extraction were directly converted into a cash windfall in domestic refining. The internal integration acts as a perfect hedge. At first glance, the top-line numbers might feed the bear argument. Q1 GAAP net income dropped to $4.2 billion. Strip out the identified items and timing effects, however, and the true baseline emerges: $8.8 billion in underlying earnings and $8.7 billion in operating cash flow. Management is actively using that cash to pull aggressive internal levers, maintaining pace on a $20 billion annual stock buyback program, heavily bolstering shareholder yield. This slide breaks down their relentless structural cost efficiencies. They have already captured $12.1 billion in cumulative savings as of 2024, keeping them directly on track to hit $20 billion by 2030. By shrinking the pool of available shares and systematically stripping out dividends and operating expenses, ExxonMobil is manufacturing growth entirely independent of the global commodity price cycle. Looking ahead, CEO Darren Woods outlined several operational catalysts expected to carry this momentum forward. The Golden Pass LNG facility achieved first liquid in March. Once all 3 of its trains are online, this terminal is expected to increase total U.S. LNG exports by roughly 15%. It guarantees exposure to every single localized crisis, even as it captures every localized boom. The bullish argument treats ExxonMobil as an impenetrable, inflation-hedged fortress. It is a machine uniquely constructed to compound cash flow regardless of the macroeconomic environment. The bearish case argues financial engineering cannot untether the company from unpredictable commodity cycles, and sprawling physical assets can violently snap under targeted geopolitical pressure. That risk is compounded by the looming shadow of alternative energy technologies, which continuously threaten to strand their massive multi-decade capital expenditures. An investor's long-term thesis on this stock relies entirely on which of these macro market forces they believe will break first. Management summarizes their future with what they call the "and" equation, the absolute necessity to deliver high-yield oil today while aggressively funding the low-carbon infrastructure of tomorrow. Q1 2026 proved they have the scale to absorb present-day market storms, but their long-term viability relies on successfully navigating the transition between current production and their new energy investments. Which path do you think the company is headed down? Let us know in the comments below, and make sure to like and subscribe for more deep dives into the markets. Please remember, the information in this video is strictly for educational purposes and does not constitute financial advice. Always consult with a professional and do your own research. In the modern global energy sector, stagnation is a death sentence. Relentless adaptability is the only surviving currency.